What is the best way to track your equity portfolio? What are the ratios and parameters that I look for when evaluating my equity portfolio? Do you want to know? Let's begin. When it comes to equity investing, I'm generally a long-term investor and I look at equities as being partner in the business. So when I am a partner in the business, I generally don't look at the price, but what I look for is ROC growth and how the business is building itself for the future. So let me just help you understand this. So first is the growth. So generally I look for a 26% CAGR growth. It should be in the DNA of the business to double its business in 3 years time. So once the business is trying to double its profits every 3 years, around 4 years time, it will generally double. So once the business is able to do that, the share price will follow accordingly, sometimes with a lag, sometimes in advance. So I generally look for growth, ROC, and then how the profit numbers are changing. So now ROC comes as a pre-investment checklist option. So we always see that whether the company has done good ROC over the past 10 years, and if it has been doing, it would continue to do so. But growth is something that I keep monitoring on a day-to-day basis. So the way I look at growth is the company should be generating good amount of profit, and that profit should be compounding at a 26% CAGR. 1 or 2 quarters here and there, then I look for the commentary in the investor presentation or in the conference calls, and those should help me understand if there is no growth or there is a degrowth or the growth is slower. Will the company make it up in the future or not? If it does, then I remain investor. If it doesn't, then I try to look for better opportunities in some other companies. So to track the future growths and future earnings, I have created a Google Sheet. In this Google Sheet, primarily my aim is to calculate the earnings. Let me just explain you in brief first, and then we will get into the Google Sheet. What it does is, it takes the earnings per share of the company, trailing 12-month earnings, and then multiplies it with the amount of number of shares that I own, and then it totals for all the stocks that I have in my portfolio. So that comes out as total earnings. So let's say if I have invested 50 lakh rupees in equity portfolio in say 10 or 20 companies, varying number of quantities, it will tell me how much the current value is and what is the current earnings of the total portfolio. So let's say for 50 lakh rupees, the current value can be 60 or 70 lakh rupees, and the total earning is say, let's say 5 lakh rupees or 4 lakh rupees. So that earnings helps me understand what is the total amount of earning that the business where I'm partnered in earning for me. And management will take the decision. Some would be plugged into the business again, and that will generate the future growth, and some is paid out as dividend. When the company pays too much of a dividend from its earnings, that is when it may be that the company is too stable and may not have a high future growth. Once the company does not pay out dividend, I am okay with it. I generally don't see it as a negative point, because it is it is putting all the earning that is being generated from the business into the business for it to get even better growth. So once the growth is there, company is not paying dividend, I'm fine with it. But generally, once I spread my portfolio across 10-15 companies, I generally see that 25% of the total earning is I get it as dividend, and 75% of the earning is plowed back into the business for future growth. Let's now dig into the Google Sheet. I will share the link of this Google Sheet in the description below, as well as in the pinned comment. You can make a copy of it and analyze your portfolio. This is not my real portfolio. I have just selected 15-20 great companies, and just to show you a demo. None of them is a recommendation, and this is just to help you understand how you should be analyzing your portfolio. So let's say what I have done is I have taken this 16 companies, and I have kept the quantity such that we have equal almost 5-6% of allocation to each of these companies, and then the price and everything comes at automatically. So all you have to do is input the symbol and the quantity that you want, and rest will be all done automatically. So now once we see that this is the total number of quantity, this is the total EPS. So our portfolio has an earning per share of 48 rupees. So it does mean that we have invested in companies where earnings per share is on the higher side. But what is more important is with a current value of almost 50 lakh rupees, 1 lakh rupees is being generated as the total earnings from these companies. So once we are generating 1 lakh rupees at a total cost of 50 lakh rupees, our PS becomes almost close to 50. So now the important part is, once you have this 1 lakh rupees as the earning generated from a 50 lakh rupees portfolio, if you have extra cash, where you should be deploying, we will understand it through this chart. So now we can see that Infosys, Reliance Industries and TCS are generating most amount of earnings for us. So once they are generating most amount of earnings for us, if we want to allocate more to any company in our portfolio, it should be this company because they will generate more earnings for us and our P ratio of the portfolio will come down because we will be buying more share of this company and it will generate more earnings. Again, these are very stable companies and they may not be able to generate a 26% CAGR, but you have to take that with the example of your own portfolio. Let's say which are the companies that are generating most cash for you, most returns for you, how they are using it. Like TCS and Infosys are paying back with huge amount of dividends, but Reliance Industries is not paying huge amount of dividend. It is plowing back the money into other businesses like Geo or retail and things like those. So once the business is putting in money into the business, it may be able to generate better return than what you can do by getting the money back. That's the call you have to take based on your analysis of the portfolio. So now once you know what is the earnings that your portfolio is generating, after say every quarterly result season, you should see an increase in your earnings for the portfolio. Once there is an increase, you will know that whether it's a 25% increase, 5% increase, 2% increase, 10% increase, and if the earnings keep on increasing, the price will eventually follow. Do you track total earnings of your portfolio? If no, this is the right time you should start doing it because it will help you to understand that when you are partnering with a business, it should be able to generate good amount of cash for you and that cash should be used to grow the business that you're partnering again. Some may pay out, some may not, but if they are generating good amount of cash, you should do well with your equity portfolio.